Hey, welcome back to Harvesting Income. This is the channel where you learn how to make your income and grow your income. So today we're going to talk about an interesting exchange traded fund which distributes every week, and the ticker symbol is RDTE, and it's known as the Russell 2000 0DTE Covered Call ETF. So let's understand what it basically does. It's basically an ETF which covers the Russell 2000, and they do a zero DTE covered call strategy. I know there's a lot of information here. So when we get into the details, I'll explain to you how the strategy works and how you can actually get weekly dividends. And it's not a scam, or it's not a false promise. It's a real case where you get cash flow or dividends distributed every week. And yeah, so this could be a great addition to your portfolio if you are looking at a small cap or mid cap investing. So before we get ahead, like let me quickly give you a disclaimer. Like this is only for educational or informational purpose. So before you invest, do your own due diligence. Your investment, your decision. So with that, let's get started. The first thing to look at is the strategy of the fund. What does the fund actually invest in? They basically invest in the companies that are part of the Russell 2000 index. Okay, so basically what they do is they invest in the index, and it would be a different type of investment or a different style here, because in this case, instead of investing directly in the index, the fund is actually taking a long position in the index using a deep in the money call on the index. So to put it in a simple language, the company is buying in the money index call. So that's the first part that you can see in the chart that I am showing here. The second part of the strategy, which you are already familiar, it is like selling or writing out of the money calls. So what type of calls they sell is basically every day they sell a call. Basically, that is called the zero day to expiry. And why it is called zero day to expiry is because these calls are, um, you know, uh, meant for every day. Basically, like they expire within the same day. A lot of calls expire on the month, on the week, and so on. There is a specific expiry date, right? So, for example, if today is a day where they trade, so on this day, the call is going to open in the morning and then close by the end of the trading session. So the fund is able to write the call during the trading session, and at the end of the day, that call expires. So it could be a profit, it could be a loss at the end of the day when the expiry happens. So the fund attempts to make profit or to generate income out of the daily call writing. So that's how they generate the income. So one is buying the in the money call, deep in the money, and there's a reason for that. Probably that's beyond the scope of this video, but they do that to replicate the price performance as if they own the stock. Like if they own the stock, they would get the same kind of performance. So deep in the money call actually behaves just like the regular stock. So that's the reason they choose that. And then they write calls on the zero DTE to generate income. So that gives us the fair idea about the strategy. And this is called synthetic call writing. Compared to regular call write, this is like a synthetic call, right? Because you're creating a replica of the long position in the stock. So that's why it's called a synthetic call position. Okay, let's move to the next part. The basic information about the fund. Ticker symbol RDTE, and price is about $33.83. This is as of September 19. The fund was started back in September 2024, so it has about just 1 year of history. So it's good to look at the numbers. Like it's still not that old enough, but we have 1 year history to look at. Net assets 155 million, decent size, and expense ratio is 0.97. And this is from the Roundhill Investments. And this fund is actually known for these zero DTE covered call ETFs, and they were one of the pioneers in these funds. Before that, they were hardly any funds which were doing the zero DTE. Probably a couple of them, but these were the ones which popularized and became very popular in the market. Okay, quickly look at the performance. I just put everything in one slide to make it easier so that you can see the big picture rather than going into one by one. The current price is 33.83 for the fund. But if you look 1 year ago, imagine that you invested in the fund 1 year ago. So at that time, you would have bought the fund at $44.88. So you can see the price has come down, like it's fallen by about 24.6%. So you lost 24.6% in 1 year. Like that's pathetic. Like it's not, it's disappointing basically. So, this the price 1 year ago, this should be 20 September 2024, and that's what happened here. And when you look at the dividends, like this is where the whole equation changes. I looked at the weekly dividends. Like when I look at the weekly dividends, I have to look back 1 year, 1 year worth of weekly dividends. So I had to look at 52 weeks of dividends to get the 1 year performance. So what I did is I added up all the weekly dividends. So that comes up to about 14.44 for the last 52 weeks. Fund has distributed about $14.44. And if you do the math, it comes to about 42.7%. That's the yield you're getting in terms of the distributions. So if you look at it net, like total returns, like it's about 18%, like 42.7 minus 24.6. So that comes up to 18%. So what I see here is it's a little jittery kind of math. Um, so so what you need to note here is overall you're getting 18% returns, total returns, but you're getting more in the form of dividends while you're getting less in the form of you're losing a little bit in the form of the price returns because you're pulling out the dividends, so the price is actually falling because of that. And also the fact that the index may have fallen or it could have gone down a bit. So those could be the reasons that this fund can have negative returns on the price front, but overall total returns would be positive. Okay, let me quickly show you the uh, you know the price last year just to give you an idea how it works. Um, Wanted to show you the price performance. Yeah, you can see the 1 year chart. Like you had bought around 44 something 1 year ago, and now it's fallen to 33.90. So that's how it looks like. Like when you look at this, you are completely disappointed. But keep in mind the fact that you are getting dividends every week in this period. Like so that is actually compensating you for the fall in the price. So you have to, when you look at the total returns, you not only look at the price appreciation or depreciation, but also the dividends or distributions you earned in that period. Okay, so having said that, let me quickly compare this fund with another fund, which is the NEOS Russell 2000 High Income ETF. That is IWMI, just to give you an idea. Both funds are not exactly comparable. The strategies are slightly different. And IWMI is also a covered call fund, but it follows a slightly different strategy. And they have a distribution of about 14.5. If you look at the comparison, like when I did the comparison on dividend channel, this is what I get. Like I'll show you the chart. I compared Russell and RDTE and IWMI. This is the chart I get. Like then look take a quick look. Rather than trying to go too much, a chart will explain much better than how I can explain. So you can look at the 1 year performance of both the funds. So when you look at that, you see that when we look at the second part of the graph, like at the bottom of the screen, growth without dividend reinvested. Like, so this is assuming that you are not reinvesting the dividends. You just invested and just holding on to it. So this is a comparison between RDTE and IWMI from September 2024 to current. So here what we see is total returns for RDTE is about 13.93%. Whereas if you look at IWMI, it is 14.55%. IWMI is actually having a slight edge in this case because um, Not only that, it's able to maintain the NAV. If you look at the start price and end price, you can see that RDTE is losing on that front. Like from 42, it fell to 33.83. Whereas IWMI, it slightly went up. Like it went up from 48.97 to 49.11. Not much, but it's still, keeping that value intact. So given that reason, they are able to show a little bit of capital appreciation and reasonably good dividend, 14%, and total return is very good. But if you look at RDT, they are able to maintain very high distributions, but they lose on the price front. So net it is coming back to the same. So in this case, IWMI has actually won the contest. Now, when I go above to the upper part of the chart, which shows the scenario with dividends reinvested. So here, the same kind of comparison. The only difference is here the dividends are reinvested. You receive your distribution and you reinvest back into the fund, so you can compound your returns. So if you are doing that because you are receiving every week the dividends from RDT, you put it back in the fund, then RDT is giving you total returns of 17.17%. IWMI, on the other hand, is giving higher than what we saw in the bottom, but 16.14. So clearly, 1% edge that RDTE has makes it the winner in the case of dividend reinvestment scenario. So when the dividends are reinvested, you're able to take out the weekly dividends and put it back in the fund. So that way you're able to compound your returns every week. You reinvest and compound and reinvest and compound, and that goes on and on over the 52-week period over the year, and 52 times you're compounding and increasing your returns. So that's the way RDTE is working in case of dividend reinvestment. I mean, this is not a recommendation that you should do that, but I'm just telling you the two different scenarios. Even if you don't reinvest the dividends, you're still getting like 15 point, sorry, the 13.6, 13.93% return, which is decent. Like you're getting close to 14%. So yeah, this is how it works. So some people may find that IWMI is a better fund. So it's all depending on the individual preferences or financial goals or what kind of risk return, risk reward ratio you would prefer. Yeah. So with that, I just wanted to say that, different funds have slightly different strategies, although they both of them are good funds and they deliver good returns. Each one has its own, pros and cons. I'll go back to the presentation. So here, this is where we stand, like in terms of total returns. And okay, as we come to the final part, like I wanted to share some of my thoughts, and also show you the pros and cons. So first, let's look at the pros and cons. Like the pros that you see here is mostly common for most covered call funds. You might have seen this even for other funds. So high distribution of cash flows, which is pretty obvious because you got like 42% of distributions per annum. And RDTE provides you a lower risk way to get exposure to mid cap or small cap companies. And there's a potential for high total returns. And high volatility also helps you to harvest, premiums for the RDTE. And if you look at the cons, like there's a lower price return or possible decline of capital. Like we saw that the price returns were negative. So that's one drawback. Like a lot of investors prefer to see stable or slightly increasing, principal value or the fund value from the date they invested. So that's one part of the cons. The other part is distributions are highly variable. So distributions cannot be constant, it's highly variable. I don't know how to explain that, but how much it varies. If I look at the website, probably I'll get an idea of how much the variation actually is. Let me quickly show you that part. Okay, now here we see the chart. It's too small, not visible. Okay, it's basically in the range of 20 to 25 cents or slightly higher. Like it depends, like 20 to 25 cents, sometimes 30 cents. It's somewhat in that, 20 to 30 cent band. Like that's the overall band that it's trying to achieve, but more on the low 20s. So I would say 25 cents is what you can expect, roughly every month on an average. It can go up and down. I'm just giving you a rough guesstimate or guess of the distribution that you can expect. However, sometimes you may get more when the markets are volatile and the fund is able to harvest more premiums. You might get more. Sometimes when the markets are very flattish and stagnant and less volatile, and you might see lower amount of premiums, lower amount of distributions. So that's how the fund works. So there you see it. Like this is going to be varying. Like there are some areas where you can see like January 2025, you can see a big bar, like it's a higher distribution. That's the year-end distribution, which is done for closing of the books at the end of the year. That is not something which is common, but if you look at the regular returns, like it will be in this range, like uh, in the low 20s or mid 20s. So that's the distribution that you can expect. And when you go back to this one, we can see, yeah, distributions are variable and you are exposed to the risk that is associated with the small and mid cap companies. So that's the risk that you are facing. Like, so whenever people ask about what's the risk with the covered call TF, like, it is not the covered call strategy that is risky. It is basically the underlying asset or what you're investing that is risky. So how do I put it? Like, if you're investing in, let's say, an asset or a stock or anything like that, Bitcoin, gold, whatever it is, the risk associated with that investment is closely tied to the fundamental performance and behavior of that investment. So even in this case, the covered call helps you, manage your strategy. But if your underlying asset or stock is not performing well, the covered call strategy works to some point. But when the underlying asset falls or the stock falls dramatically, then the downside risk is always there. So the downside risk with covered call position, holding an index and covered call, is basically the same risk that you have with the index, plus minus the amount of income that you made from the covered call. So as long as the index is stable, then you can still make good income from the covered call. That is one of my observation. The second observation is like people talk about like what's so special about this covered call. They are just giving back the money in the form of return of capital, or they're giving back my own money back to me. Okay, the way the funds work is like they have the capital that is raised from the investors and they invest in these trades. They have to buy the stock and they have to sell calls on these underlying assets. So when that happens, there will be a distribution caused by the amount of premium earned. And the fund earns premium. The fund is not actually providing you the dividend. Wherever I say dividend, I am actually referring to the distribution. The fund is making profit by trading the calls and earning the premium, and that earnings are distributed to all the unit holders. And that's how these distributions are being, earned by us. And the reason why the distributions are pretty high is the premiums are returned in such a way that every month they are making a good amount of return, like every month or every week, depending on how the calls are written. They make X amount of return on that every trade. So whenever those trades are made, they make that money. It could be profit, sometimes it could be loss. So let's say they make 10 trades and 7 trades are successful and profitable. Like 3 trades did not go well. So that will help them to, show a overall positive return. And then that income or distribution, that income or premium they earn would be distributed to the unit holders. So that's how the funds work. Like. So so all said and done, these funds have a very high distribution because of the premiums which are earned. They have to distribute a major portion of them. Probably they can retain a small portion of the distributions that will help manage the net asset value, and some funds do that. And I cannot name any specific funds here, but there are different strategies that the funds use to either distribute high amount of yield, or they would retain some of the distributions to stabilize the net asset value. So RDTE is a good option for someone who is looking for a regular cash flow weekly. And disclaimer, I am also holding RDTE, but this is not a financial advice. I would suggest like you should have a very small portion on this fund because it is exposed to small and mid cap companies. It's a bit risky, but the good news is you are investing in the index, not in the individual companies or stocks. So that way you are benefiting from that space in terms of high growth or high capital appreciation. But at the same time, you are getting that weekly cash flows or yields, which is stabilizing your investment. So if you are using it correctly or if you are using it in a limited fashion, this could add a lot of cash flows to your portfolio. So I hope you like this video. If you liked what you're watching, please share it with your friends or family and share your comments below as well. Thank you. Have a great day.